Hello there, Prof. Aram here, and in this video I'm going to go over the concept of security market line and one of the most popular equations in finance, which is the capital asset pricing model. So let's get to this. Remember that the risk premium is the expected rate of return minus the risk-free rate. And we know that the higher the beta or the systematic risk, the greater the risk premium should be. So can we define a relationship between the risk premium and the beta so that we can estimate the expected rate of return for a stock? And the answer is yes. Now we are in a position to see how risk is rewarded in the marketplace. To begin, suppose that asset A here has an expected rate of return of 20% and a systematic risk measure of 1.6, the beta of 1.6. Furthermore, we are going to assume that the risk-free rate is 8%. So in this case, if you want, you can form a portfolio and invest part of your money in the risk-free asset and part of your money in the risky asset. But let's just assume that you want to invest everything in the risky asset. So what is the slope of this line? As always, the slope of the line is the rise over run. So the rise is going to be the difference between the expected return on the asset and the risk-free rate, and the run is going to be your beta. So the slope of this line is going to be the risk premium of that asset over the beta of the asset, which is going to be 7.5%. We call this ratio reward to risk ratio. Basically, what it tells is that asset A offers a reward to risk ratio of 7.5%. In other words, asset A has a risk premium of 7.5% per unit of systematic risk. Now, we call this slope the reward to risk ratio. So the reward to risk ratio is the slope of the line illustrated in the previous example about asset A. So in equilibrium, this reward to risk ratio should be the same for all assets. In other words, the expected return of asset A minus risk-free rate over beta of A should be the same as the expected return of asset B minus risk-free rate over beta of asset B, and so on and so forth. So let's see how it works. Here we have another asset, asset B, with a beta of 1.2 and expected return of 16. So in this asset, the reward to risk ratio is 6.67%. Now let's put these two together. We have asset A and asset B in the same graph. The key thing to notice is that when we compare the results of asset A and B, as it is shown in this graph, the line describing asset A always outperforms asset B. How come? So for any level of systematic risk, so let's say if the beta is 1.6, asset B's expected return is less than asset A's expected return. So however you look at this, asset A is outperforming asset B. So what happens in this case is that in a well-organized and active market, because investors are evaluating different assets all the time, they will see that asset A provides higher expected return for a given level of systematic risk. So what they do, they're all going to buy asset A and sell asset B. In other words, they will drive the price of A up and the price of B down. And because prices and returns move in opposite directions, the result would be that the slope of the line for asset A will become less, and the slope of the line for asset B will increase to the point that we are going to have one line for both assets. Meaning that we are going to see that expected return of asset A minus risk-free rate over beta of A will be the same as the expected return of B minus risk-free rate over beta of B. So they will basically they will converge into one line, and both assets will have the same reward to risk ratio, will have the same slope. So the basic argument can be extended to many different assets, can be thousands of different stocks, and the argument is that all of them should have the same reward to risk ratio. So the reward to risk ratio must be the same for all assets in the market. The result is not surprising. What it says is that, for example, if one asset has twice as much systematic risk as another asset, its risk premium must be twice as large. So again, in equilibrium, all assets and portfolios must have the same reward to risk ratio, and this can be extended to many different assets. So we can see the result of that here. So here we have the security market line. And by the way, this line that every asset will converge into one line, we call this security market line. So let's say we have this security market line, and we are in an equilibrium. So asset A and asset B are priced correctly, but you see some mispricing for C and D. In other words, for the stock C, for a given level of systematic risk, the return should be here. But the stock C is offering higher return. So what happens is that everybody is going to buy C, which drives the price of C up, and then the return down, which the result would be the expected return of C will converge to this line, the security market line. For D, the opposite is true. For a given level of systematic risk, the expected return of D is less than what the security market line suggests. So everybody's going to sell this, which drive the price down and increase the rate of return. So this will go back to the security market line. Overall, we call this line security market line. And when you look at it for a market portfolio, the slope of the line, beta of the market, which is 1. So the slope of the security market line is equal to the market risk premium, which is expected return of the market minus risk-free rate. So the reward for bearing the average amount of systematic risk. So the average amount of systematic risk is beta of the market, which is 1, and the market risk premium is the reward for bearing that. So the equation that describes this line is this. We call this CAPM, or capital asset pricing model. Let's see how we derive that. So we have the security market line as the representation of the market equilibrium, and the slope of the security market line is this: expected return of the market minus risk-free rate over beta of the market. But since the beta of the market is 1, we can come up with a slope of the line that is the market risk premium. So if you look at this, let's say the security market line is basically saying that expected return of asset A minus risk-free rate over beta of A should be the same as the expected return of market minus risk-free rate over beta of the market. Since this one is 1, we can rearrange this to calculate the expected return of any asset, which is the risk-free rate plus market risk premium times beta of asset A. So this capital asset pricing model shows that the expected return on any particular asset depends on three things. One is the pure time value of money as measured by the risk-free rate. This is the reward for merely waiting for your money without taking any risk. The second part is the reward for bearing systematic risk, the market risk premium. We call this the price of risk. So this is measured by the market risk premium. This component is the reward the market offers for bearing an average amount of systematic risk in addition to waiting. And then finally, the third component of the return comes from the amount of the systematic risk. So this is the price of the risk. This is the quantity of the risk that you're taking. This is measured by the beta of the asset. And this is the amount of systematic risk present in a particular asset relative to the average asset. So you can use this information that we have and calculate the expected return on any stock in the market. So for example, you can use capital asset pricing model to find the expected return of these four stocks that we saw before. Consider the beta for each of the assets are given. So these are the betas. The risk-free rate is 4.15% and the market risk premium is 7.5%. All you need to do here is just plug in the numbers that you do have in the CAPM. So your risk-free rate plus the beta times the market risk premium will give you the expected rate of return for each of those assets. So here's another example. Consider an asset with a beta of 1.2, risk-free rate of 5%, and the market return of 13%. What is the reward to risk ratio? The reward to risk ratio is the expected return of the market minus risk-free rate over the beta. So the reward to risk ratio in this case, so you have the market return, expected return of the market of 13%. So expected return of the market minus risk-free rate over beta of the market, which is 1. So you'll have 13 minus 5 over 1, which gives you 8% for the reward to risk ratio. And the expected return on the asset, we can use the CAPM formula, risk-free rate plus expected return of the market minus risk-free rate times beta. So we have 5% risk-free rate plus 13 minus 5 times 1.2 for the beta, which should give us 1.2 times 8 plus 5, 14.6%. I hope you find this video useful and thank you for watching.